the four indices that we typically look at. Right out of the gate, stocks are still opening. Maybe it's too early to look at market breadth, but it's kind of evenly matched as we begin this particular session. Just a quick heat map, which will give you a snapshot view of how many are up and down in the Nifty 50 stocks. So it's mostly all about, 40-odd names are lower, and you got about 11 names which are actually higher at this point in time. I can spot some financials at the bottom of the screen, so let's get to stocks. Rima.
Well, the top gainer is HDFC Bank. The street is excited with the bonus announcement. Stock is up 1%. HDFC Life, top line looked good. Margins were a bit subdued, but the stock is up and about in trade. And SBI Life, that too is moving up in company. SBI Life is a gain of nearly about 0.5%. HCL Tech was the top Nifty loser yesterday. It fell by more than 3%. There hasn't been a recovery in HCL Tech. I don't think it's fallen more, but it's a flat opening for HCL Tech after yesterday's fall. On the way down, Reliance Industries is struggling. Remember, it comes out with numbers on Friday, post-market hours, and ahead of that, Reliance is under pressure. Shriram Finance is seeing a big fall. In fact, that's the only one with a fall of more than 1%, and it's straight away 4% gone on that. Did I miss the news on Shriram Finance? 4% down, large volumes. And no other stock is showing this kind of an exaggerated move, either, on the way down. So at least Shriram Finance is, seeing a big fall. Outside of that, Cipla, Bajaj Finance, Hindalco, JSW Steel, and ICICI Bank. Metals too appear to be a tad on the back foot.
Well, that's right. A few stocks in the broader markets that are catching your eye. Coffee Day, the stock is up 10%. So big volume out there. That's coming up one of the top volume movers. Biocon, the stock has relatively underperformed if you look at it for the last few years. But now that biosimilar getting a green signal, the street likes it. And that's why, in fact, that stock is up and about in today's trading session. Hathway Cable opens up with a gain of around 4%. Network 18 is up close to around 5%. Due disclosures, please note. Both those two are doing quite well. Edelweiss Financial, well, that one as well is up close to 2%. These are all the top volume movers. HDB Financial, that's reacting negatively to its results. I think we should get that one as well up for you on the screen. It's seeing a 2% downtick. And Diffusion Engineers, that's one of the new listings out there. That's up close to around 5% as we speak. So good up move is what we're seeing on that one, on fairly large volumes as well. In terms of losers, I think Shriram Finance, that's the one that's calling for attention. And Newlin Laboratories, I think this week it's up 20%, even after the 4% pullback that you're seeing. So some kind of cooling off after the big run, as is the case with ITD Cementation as well. Stock now down 3.5%.
Absolutely. So it's quite a start. Nifty, the bank's index is doing much better. With 57,130. The Nifty is slightly lower at about 25,160 at this point. Small caps are doing up. They're up about 1/3%. Maybe if you can just quickly look at the IT index, and then we'll move on as to see what's happening in the rest of the space. I mean, IT index absolutely flat for now. Let's welcome in our market master today. Samir Arora is founder and fund manager at Helios Capital. He's with us. Samir, great to have you with us as always. Good morning. I want to start with exactly that, which is IT services. I mean, you've had this pet peeve for a long time with IT and their acknowledgement or lack of acknowledgement of the disruption. Let's just start there. What you made of the earnings and go on. Yeah, please.
I think more than that. First big goof up is that not to invest in any new technology, helping others, do this. For example, if you've heard of a company called Zscaler, founded by two Indians, those Indians are worth combined husband, wife, some $18 billion. To see all this happening and to help others, but because of this fascination with cash flow and dividend yield and buyback. So, we are stock market guys and we like people who care about stock prices. But still, there has to be in not 1 year, 2 years, now 20 years have passed to not make $1 worth of investment in all these new technologies happening in front of you, not in front of us, but in front of them. To not do it is very disappointing. Second thing is, as I said, lack of acknowledgement, which actually distorts many careers. Because even today, if you keep saying everything is good and you don't openly discuss because next quarter price might be down, how many people are now learning coding when you know that the coding job will be 1/3, say half, whatever. 10 years later, 5 years later, you have to guide the world a little bit every day to only focus on what is to delay. I have delayed my hikes because this quarter margin will be lower, higher. I mean, this is overdoing. If you have to give it now, how does it matter that this quarter my margin will look 10 basis point lower, but next quarter I will save something on travel, so I will give a hike. I mean, this is just over catering to the market, which otherwise I like, but they are disappointing on many levels, philosophically and on a day-to-day basis.
You think at some point there will be a pivot, and you will, as investors, I mean, at the end of the day, viewers want to know whether they, money can be made here.
Of course, I will do it, and then I will come and confidently tell you why I like them at that point of time. But the point is, today I don't, and I haven't. And this issue is a bit serious. So this issue is, you can say, like the consumer staple guys. You are still the best companies, big companies, important for country, important for foreign exchange. It's just that your growth is gone. And when the growth is gone, you try and find all these bad, I mean, sort of in hindsight, you can call it, I don't care. But right now it is bad. So there is no point in saying that, now it's too late. It's not late, according to me. And we are not just telling you, you can see our portfolio, what we have and how much we have. And we also don't like, 3-4% kind of growth. Who cares for 3-4% kind of growth? If that is the case, then maybe the PE should be like HPCL or something 5. Then you might say, okay, doesn't matter. One day something will happen. But if you're already trading at these valuations, then you don't want 2 years of 5% growth, because one day it might become 6 and surprise everybody. That's too boring.
Okay. IT is boring. But other than that, you like the market, you said.
I like the market. I have broadly liked the market. In between, there was this confusion that I had on this India-Pak war and all. But this time we realized that, these things get sorted. Unless they become very bad, then of course that is a low probability event. But generally, these things get sorted in 10, 15, 20 days. And then sort of the rebound is at least half to 80% and move on. So I've been bullish on two things for India, that is. One is that for last 6-8 months, not now, but say 2 months ago, from say September onward, there were big FII outflows driven by people feeling that they should go back to US. And so in September and January, there were very big sales of maybe more than 25 billion or so in 2 months. I mean, in these 2 months, not together. And then since April, May, it is clear that the world is not fascinated by US to the extent that they want to put back everything that they may have sold. And you can see that from flows into ex-US ETFs. There's a MSCI World ex-US ETF. There were articles on how many billions it has got suddenly. Even we in our global fund have reduced US weightage from 70% to 50%. And the world there's so many things you can read on that the world has slightly brought down their US, if not this much. For the first time in many years, the ex-US index is beating the US market. And therefore, if that happens, and there is a shift of 3-5% from the current US exposure of 70% to say 65%, 68%. That is massive money for the rest of the world. And in that, India has a strong case. India has a case in terms of inflation and interest rates and liquidity. And so even if we just don't get outflows, and plus the currency dollar is depreciated, so that's another reason why people don't like that much US. So if that happens, then just by not having outflows will be a big positive compared to what we have seen in recent 6-8 months.
So, Samir, you said that in your global fund, you brought down the US exposure from 70 to 50%. Yeah. So, which other markets have you deployed that money into, and how much?
So, we used to have this, by the way, fund went from 70 to near zero. Fortunately in Feb, so it has been brought back. So what we've done is we used to have 5-7% in China, which we are now targeting, still haven't reached, but 15. So we are at 12 or so. And we did not have gold in that fund. I used to personally own gold. But in that fund now, we have already bought 5% gold. And we are going to keep these forever now. I mean, ever means, let's see. And then the rest is in, we had these 8-9% in these 2 Indian ADRs all our life, which have not helped, particularly, which one. I hope one day it helps, which is HDFC Bank ADR. And the rest is rest of world, 20%. So 50, 15, 5, 10, and 20.
All right. Hi, Samir. Good to hear you this morning, and thanks a lot for joining in. Samir, what about, the Indian economy? How are you reading it? Because urban India still appears like it's very, very slow. If you look at, numbers coming out of Trent and the likes, which one would say is a little bit worrying. However, inflation has cooled off. And if I look at the nominal GDP, it's going to be sub 10% in all probability. So one way to look at it is the RBI is going to pump it up even more. We're going to get further rate cuts, which in turn could be the start of a fresh leg on the up move. How are you reading these data points that are coming in there?
So right now, if I look at it purely from earnings point of view, earnings are not great. As in this year, you can't grow more than 10% here or there because IT growing below 5 maybe. The large consumer companies growing 4-5%. The large banks or banks in general growing below 10 because of NIM compression and all that. But at least that one hopefully gets sorted out in 3-6 months. So for this year, whether we are positive because of flows, we are positive because of interest rates, we are positive because of SEBI and RBI being pro-market in some sense by reducing some regulation, putting in liquidity here, there. Still, you can't make obscene money, which would, according to us, be 20%. So you will make 10-12%. If you see now year to date, the market is up some 5-6%. So more or less, 0.8 to 1% per month, if you get, that is enough. So that issue is there, and you need a new cycle of something or some of these to do better. This negative overhang of IT is also actually going to, over time, feed into our consumer sector. So it's not straightforward, but 10-12% return is still reasonable to expect for some time, and they're hoping that some of these things, either because of pumping of liquidity or interest rate cuts or whatever, goes back to a little higher than they are now, and therefore the overall market growth is about 13-14%, which is sort of normal. Right now it is below normal.
No, absolutely. I got that. By the way, Samir, there is, with regards to what the RBI wants to do, what we've been sort of hearing, picking up, and there was the RBI governor interview yesterday as well. I mean, they're very, and we've heard from the horse's mouth, but also generally feedback, people who go and give suggestions, etc. When the RBI wants suggestions, I mean, it seems to be squarely focused on growth. I mean, asking banks, tell us what you need. And they're very focused on kickstarting another credit cycle.
Because we need it.
We need it. So if they're successful, even mildly successful, where will this show up in your way from an investment point of view? How do you connect it?
So as I said, the first thing is that in financials, we expect that the growth rates will go back. That is in the banks and all. I am still a little bit hesitant on our own sub-segment, which is capital markets, where again, we are getting carried away that every day the volumes have to go up and depository accounts have to go up, and all that is, we are over pushing it. For example, I saw on Twitter somebody saying that BlackRock has some 12 trillion, therefore the asset management companies in India can grow forever. I mean, if this kind of wild connections are drawn, even though we ourselves own HDFC AMC, and of course we own our own Helios AMC, but still, we don't want to overdo these things. But before that, India, as of now, also seems to be a relative beneficiary of the US trade deal, because at least so far it has not happened. And if we finally get some 15% even, then all our competitors, China has 35 right now, 10 plus fentanyl, Vietnam has 20, Sri Lanka has more. Also, all these similar guys, Japan has 25. So even if we get below 20 anything, I hope we get 10, but let us say that looks a bit very optimistic right now. That also will be on the margin positive. So overall, it's okay. But in terms of the portfolio, we are still in the same old, which is financials and discretionary consumer a little bit. And then a few here and there you can see in different places, but no. Because there are three big pockets: consumer, IT, financial. And if you don't have IT, that leaves a big gap. And therefore, you have to cover some other angles to spend that money or invest that money.
Samir, any new idea as an idea that you want to talk about?
No, we don't want to talk about because...
Talk as an idea. that
You
you
can
want to...
see them in the mutual fund disclosures, and you can talk to the mutual fund manager or that team.
But I think the Flexi Cap Fund has made 4 additions in June. Siemens Energy India, Vishal Mega Mart, Niva Bupa Health Insurance, and Swiggy. So
I'm delighted to hear that you are reading your sister company's articles. From Control. You should have your own articles.
Oh, who told you that's not our article? That's our article.
I also saw it today morning on Money.
No, Samir, you're wrong. We are reading our own content.
It's your own company, actually. Anyway, point is, by the way, the Flexi Cap is doing very well. If you see it from, Jan was bad, but overall, if you do 1 year since inception, 1 month, 3 months, since February 1, it would basically massively beat the market. If you see it from inception, it would have beaten by more than 9% in less than 2 years, which is quite big and bigger than the biggest guys who are more in the news every day.
I got that. Do you think, one thing I've heard from many is insurance. I mean, again, we've spoken about financials, but insurance perhaps, in a way, does better and better. The last 2 years, again, like many others,
Correct.
Lots of regulation, lots of changes, but now it's settling in. We, of course, still are waiting for the new IRDAI chief, but they perhaps will be a little bit of a pivot, more friendly to industry, etc. Any thoughts?
So we have 3 actually now in all our funds. HDFC Life, and we bought this Nuva Bupa, and we also have ICICI Lombard. And the first reason was that they had done very badly. Like HDFC Life in the beginning, after a very successful IPO and all its returns being made in the first 2-3 months, I think. Basically, for 3-4 years, the stock market performance was ordinary to zero, and then the fundamentals caught up. And big picture is positive for this theme and this sector anyway. So if the theme is otherwise good, you just buy the obvious candidate also is enough sometimes. And these are the obvious candidates in this field.
And I think Bajaj Finance as well, you're topping up out there, right? That's
Bajaj Finance, we are topping up means actually that topping up is because that fund gets new flows.
Oh, okay.
But otherwise, all are buying. We all have it. Even I have it here. But the topping actually, in some sense, sometimes doesn't show. Sometimes doesn't show. We are very positive, very bullish. But what I'm saying is, every move in a mutual fund, you should take a little differently from, say, some other fund which has, sort of a more or less a regular size rather than like the mutual fund getting every month. Mutual fund is a good business, I must say. Every month the flows are very big, and it is very heartening and pleasing to see that every day. But that also means that you don't interpret every stock trade as a new something.
Samir, quick word on gold, because that's, as you said, the recent addition, at least in the global front. You've had it personally.
Yeah.
I mean, it's had such a phenomenal run. So it's very hard to make that argument that those kind of returns, or smart returns, will continue even in the future on that kind.
Actually, the thing is, this is the whole story which nobody knows. That the whole reason for being, not whole reason, but one of the reasons for being confused about US by the world is that the US debt is unsustainable. If you read this Ray Dalio book, Why Countries Go Broke. So all these things will lead you to believe that it is okay if you don't make much money on gold, but you don't want to have a situation where the currency in US goes a lot. Where Ray Dalio says that in 3 years, US will have a seizure plus minus 1 year, and he has written a whole book basically to lead to that conclusion. And we can see that the world, there is not enough of an alternative, as in if you don't like the US dollar, it's not that the world likes euro or the world likes yen, or they believe that those can take over. But gold is a neutral, this thing, and it is, you can say, insurance, but also it's a hedge, you can call it, whatever you want to call it, to against the fact that the US goes bad. And, of course, recent days, the US market has done well. But every time these tariffs were increased and uncertainty was increased, and basically President Trump was very aggressive in criticizing other countries, for example, saying they are coming here to kiss my ass or something. So all these things would make you feel that these other countries will try, if they can, reduce, limit, but at least definitely not overly support the US Treasury.
You could have said, just kiss me.
So I'm saying every time it looks to me that the word which was friend of US might say, now it is deal to deal, trade to trade, and just randomly putting everything in the US, if they have surpluses, all that is changing. Whether it is for
Absolutely.
fundamental reason or personality reason or ego reasons of everybody.
You know, laughter in the morning, Sameer. I mean, that's what your conversation with you always leads to. Lots of gyan, insights, but really sort of, some laughter as well, which all of us look forward to. Thank you very much for joining us. Great speaking with you, and appreciate your time here on CNBC TV18. I think the market's not doing very much, 50 odd points lower, 25,150. But, the deal pipeline, Reema, Nigel, in terms of blocks and IPOs, etc., supercharged.
Indeed. So let's straight away get to, the big block deals. The most recent one was the one that we saw in VIP, where Multiples and Sancheti Brothers picked up about a 32% stake in Piramals. But there have been so many others, and the IPO pipeline continues to remain red hot. So to decode the key drivers, the trends, the pipeline, we're now joined by Bhavesh Shah, Managing Director and Head of Investment Banking at Equirus, and Rahul Modi, Managing Director, Co-Head of Investment Banking at Ambit, joining in. Gentlemen, thank you very much for joining in. So just to first understand, the numbers in the first half of this calendar year, and what the numbers in terms of M&A and IPO pipeline that you guys see in the second half of the year. Bhavesh, you want to go first?
Sure. I think, Reema, thank you, first of all, for having me on the show. We are seeing a lot of activity across the board, be it IPOs, be it M&As, be it block deals. This is a investment banker dream that we are all living. We all grew up as analysts to where we are today to see this kind of an activity. But if you were to really look at it in terms of numbers, I think M&A was something like $25 billion year before last, but it's now become about $30 billion in 2024. What we are seeing is a multitude of game change in terms of optionality, which the companies have. Today, they can actually list the company. They can actually sell their stake through block deals, not necessarily through an M&A, but also an M&A is an option. So it's a multitude of options which is available for the companies, and that's how the trend is looking at in terms of numbers, etc.
All right, good to see you, Bhavesh, as well as Rahul. Thanks a lot for joining in. Rahul, let me come across to you. The recent few deals, SML Uzuzu, you have the deal in the paint space, Akzo Nobel, and recently VIP as well. All the three deals, well, they're viewed very, very positively, and they're large-sized deals as well. However, one would say that all the three deals got done at a sharp discount. How are you reading it? One would say it's good for the industry, good for the country on the whole. However, do you think some of these were distressed sales? The promoter entity out there was a little bit more desperate to get out of the business?
First of all, thank you for having me on this discussion. No, I wouldn't say so. I think each deal has obviously very specific deal dynamics. So I wouldn't generalize or say that they were distressed deals. Obviously, you have to consider where and I think a number of deals you mentioned are publicly traded, and obviously the markets and the valuations have been quite good. And it's quite normal for some of the secondary deals to be priced at a discount. So I wouldn't say so.
All right, Rahul, fill us in with your view then. How's the pipeline looking? If the markets remain very, very buoyant, then this deal street is likely to keep buzzing. Your take?
Absolutely. So, see, as Bhavesh said, I think we are seeing a very significant activity both on the M&A private capital raise as well as public markets, equity capital markets. The volumes on the M&A side have been quite robust. And I would say there are maybe identify four drivers for this. One, which is very basic, is I think we had great last year in terms of the equity capital market performance, but that was corrected a little bit earlier this year, initially because of this whole global tariff situation and a bit of geopolitics. And what that did is had some correction in valuation. Obviously, markets have gone up since then. But that makes the deals between buyer and seller and agreement on valuation more possible and pragmatic. So that's a very key driver, I would say, for M&A surge this year. Secondly, if you see, and in fact, you named a lot of the deals, but if you see one theme that has emerged is the large corporate houses have done, very meaningful M&A. So if you see, you mentioned JSW, ExxonMobil, Bajaj acquired Allianz's stake. Mahindras have done a few deals. Torrent did JB Pharma. So, there has been a spurt in activity from large corporate houses. Thirdly, private equity has been pretty active, both on investments as well as exits. And some of the exits have been through IPOs and blocks, but some have been through M&A and secondary sales as well. There has been focus on control deals from private equity. And it's not only the traditional private equity houses. You see real estate funds, infrastructure funds, pension funds, sovereign wealth funds also participate. And lastly, and again, that's something you touched upon, is that while even if they've corrected, the valuations are still good. So what we are seeing is, monetization by some Indian promoters or even foreign strategics. So you mentioned about VIP deal. We know the ExxonMobil deal, but there are a couple of Whirlpool is there. There is Novartis. So I would summarize all these four factors are contributing to very robust M&A pipeline.
I did a couple of these discussions, and we spoke with Ramdevji as well. And one thing he said kind of stayed with me. He said, well, so much supply essentially means that perhaps it puts a bit of a cap on the higher side. But a lot of the money which is being taken out, I'm talking about exits from PE, VCs, promoters, etc. A lot of it basically comes back into the market. So that kind of also provides some sort of a floor as well. So PE and VC exits last year were about 1.15 lakh crores. This year so far, this is till the 3rd of July, that number is close to about 40,000 crores. And of course, promoter exits 2 years in a row, 23 and 24, a lakh crore plus. And this pace, we're at about 65,000 crores already. I think we'll beat the last 2 years as well. But I just want to quickly get for our viewers, Bhavesh and Rahul, right? As they say, buyer beware. Deals will come, and promoters and everyone will try and maximize. Where is all this stock going? It's going to DIIs, and DIIs are buying because they're getting all this money from retail investors, local investors in many ways. The quality of paper, I just wanted to quickly, if you both want to weigh in for 30 seconds each, Bhavesh, in this cycle where we are right now, what do you make of it? What's coming to the market?
So Prashant, I think it's a very fair observation, and obviously great amount of activity happening, which also leads to the question as to whether it's really good quality paper coming into the market at the cost of the retail investors. But I must tell you one thing, is that the mutual funds, the institutional investors, that is, they have significantly upped their game in terms of the processes, in terms of the work and the diligence that they do in identifying the companies or where they want to invest, and the pricing as well. There's an extreme amount of discipline which is there. And I think it is but natural, because all these institutions have scaled up significantly because of the money coming in. Every mutual fund wants to grab a share of this 27,000 crores which is coming in. So they better be sure about what kind of companies they're investing in. Are they making good returns or not? So there's a
Bhavesh, absolutely, point taken. But as I don't know if you heard Samir earlier, right? Towards the end, he said one thing. He said, because we are getting this gush of money, so anything we do, don't take that as this new kind of big view. You just you're getting the money, you got to put it to work. So while I take your point, but it is also just the function of the fact that you can't sit on cash. You've been given money, this gush is coming in, and you got to put that to work.
And exactly, which is why this supply of high quality paper really helps. And if I were to correlate this to M&A, for example, earlier a large stake sale in companies would invariably have to be done through strategic. Now strategics will try to really bring the valuations down, or kind of arm twist on the valuations. But now with the markets opening up, with the private equity opening up, the optionality of good quality paper coming at reasonable prices has also come up significantly. So the incentive for the companies to go for markets rather than do a strategic is there. At the same time, there's a good supply paper coming in, which kind of absorbs this liquidity in the market.
Rahul, have you seen a distinct increase in PE-led acquisitions or consolidation? So the most recent one was Multiples and VIP. Then there was Temasek-backed Manipal acquiring Sayadri. Before that, Bain Capital invested about 18% in Manappuram. So compared to the last, say, 3-4 years, have PEs become more active in India?
Yes, absolutely. I think, and it's been very steady. So if like last year, maybe just the PE investments were $30 billion. And we see this year tracking that and probably doing a lot better. As I was mentioning, we see a great level of confidence in PEs across sectors. They are willing to do more control deals as well as significant minority deals. And this confidence comes from economy in general, the business case of particular investments, but also their confidence in exits. And I think, as Bhavesh mentioned, you have multiple options to exit now. So we're definitely seeing that, and there's been across sectors. Consumer, we've seen a couple of very large trades like Haldiram, Theobroma, which got announced very recently. There are a few in pharma and healthcare, KKR acquiring HCG and so on. So another aspect of this is that it's not only the traditional sectors, but there is a lot of capital that is coming into real assets, so real estate. So Blackstone acquiring properties in Kolkata. Infrastructure has been very prolific for the last few years, and I see that continuing. As you know, there has been extension of certain tax benefits which are attributed to pension funds and sovereign wealth funds, which were extended by full 5 years in this budget. So that story is going to continue in every possible infrastructure, roads, renewable, digital infrastructure, energy infrastructure, and so on.
Yeah, I mean, that real assets story, right? It's very, very small right now in India. I mean, if you look at the sort of market cap of, say, REITs as an example, compared to how large that market is in the US. But maybe things will pick up on that particular front as well. We're out of time. I had a couple of more questions, but maybe we can request both of you to come back on the air. Bhavesh and Rahul, appreciate you joining us here on CNBC-TV18. Thank you. We'll take a quick commercial break here. We'll come back. We'll have the management of ICICI Lombard join us on the other side. We talk about their quarter numbers and, of course, the outlook more importantly. Okay, welcome back. ICICI Lombard is the next management as promised on the program. The stock's higher. It was high yesterday after it reported good set of numbers. Net profits have risen 28%. to 747 crore rupees. We are now joined by Gopal Balachandran, Chief Financial Officer at ICICI Lombard. Thanks very much, Mr. Balachandran. Good morning, Prashant here. So if you look at the net earned premium growth, that is in line. But if you look at the PAT growth, as I just mentioned, that is much higher, 28-29% kind of growth is what we've seen. Could you just briefly tell us what led to this very sharp move on the bottom line front in the quarter?
Morning, Prashant, and that's a great question. I think from an ICICI Lombard standpoint, I think we have maintained it even in our earlier calls. As a company, what we have tried to do is to stay focused and be disciplined in terms of our insurance outcomes. And more importantly, also kind of leverage the investment float that we kind of generate in our business and put it to optimal use. So the number of 28% growth that you see, I think the markets have been kind in the quarter. And therefore, to that extent, whatever growth that you see is a combination of both an improvement in our insurance results, which is largely reflected in the combined ratios. And equally, obviously, there has been an improvement in our overall investment income. A combination of the two is what has led to a growth in profits of 28%. But as we keep saying, I think some of these, how sustainable, I think better is to always keep looking at results more on an annualized basis. That will be far more reflective of what one can expect insofar as the full year operations are concerned.
Mr. Balachandran, and that was exactly my question, because during the quarter, because we get these monthly numbers, right? Except, I think, retail health, across all other segments, ICICI Lombard sort of gave up a little bit of market share. So is this performance sustainable, or do you think we will eventually see deceleration in premiums as well as we go through the rest of FY26?
Again, that's a great question if you ask us. I think that again, let me just put this in context. I think let's look at in terms of where the market is currently positioned as. One is in terms of what is it that you can exhibit as top line growth. And the second, what I said, what is it that one can exhibit in terms of profitability outcomes. If you look at the overall market, the industry is kind of currently losing roughly about 12 to 13 rupees for every 100 rupees of premium that you collect. So which is why the industry combined ratios are operating at around 113%. So when there is so much of underwriting losses, I think from an ICICI Lombard standpoint, what we have always tried to do is to obviously accelerate in segments which we think are preferred segments at this point of time. At the same time, be guarded and cautious and wait for the cycles to turn around and obviously seize the opportunity for growth as we head into the subsequent quarters. And that is how we always operated as an institution. And that's the reason, not just now, even at any points of time, generally, if you see relative to the industry combined ratio number that I spoke about, ICICI Lombard's combined ratios have been kind of better by at least about 10 percentage points or thereabout. And to the markets, what we have been largely talking about is to see how we can continue to deliver a sustainable return on equity in the range of 18 to 20%.
Okay, all right. Hi, sir. Good morning. Good to see you, Ben. A couple of quick questions then. So you're saying that you'll outgrow the industry and the combined ratio as well will be far better. Could you put a number to that? What kind of industry growth are you working with? I think in the past you've said that you'll outbeat industry growth by 100 to 200 basis points. So do you hold on to that? Are you looking at any kind of price increases as well, price tweaking? Give us clarity on both those two fronts.
Again, Nigel, I think that's a great question if you ask us. So again, let me just put this in context. I think when we had kind of talked about us outperforming on growth exactly to the numbers that you indicated, which is about 100 to 200 basis points, that's relative to, let's say, where the market is expected to operate at. Vis-a-vis that, what we are seeing at this point of time is obviously elevated levels of competitive intensity. And therefore, to that extent is what I kind of talked about, to be a bit guarded or cautious. And in that context, I think we are happy to kind of let go market share, particularly around these times when the market remains elevated. Having said that, obviously on the segments where I think things have been reasonably good for us in terms of the pricing regime, I think we have continued to stay accelerated, whether it is growth in our retail health book, within the commercial lines, whether it is a growth in the SME segment, I think that continues to do well. Within the motor segment, if you were to see our shift in mix to private car relative to, let's say, commercial vehicles. So that's how we have kind of obviously kind of moved across business lines, depending on what environment that we are seeing in the market. Your second point on price, where do we see the price? I think the good part is, again, let me kind of pick each of the segments. Commercial lines, if you recollect, last year had a tough time in the pricing market environment. this year, clearly, if you see the numbers that is reflected for the overall industry also, the pricing seems to have kind of come back reasonably well, though not fully to our expectations, but there has definitely been a price improvement. On motor, I think there has obviously been from an industry an ask to possibly seek an increase in third-party price. We will wait and see when that final notification comes through, and we'll be happy to talk through whenever it happens. But in general, there is definitely a need for price increase in motor because industry combined ratios on motor are operating at 124%. On health, I think again we have spoken about from an ICICI Lombard standpoint, the loss ratio range on an annualized basis, which we are comfortable with, is between 65 to 70%. And at this point of time, looking at how things are playing out for us, it seems to suggest that we should be within that range.
Sir, thrice you referred to elevated competition in the industry and how one needs to be guarded. Can you describe a little bit more about what we are seeing with respect to the competitive intensity and what's the extent of market share loss that you've ceded? What's the number?
Yeah, so again, if you look at it, let's take individual segments. Let's take motor. We would have lost roughly about 0.5% market share. We touched almost close to about 11.1. As we speak, we are at a market share of 10.5%. And this is not just this time, Rima. I think in general, I think our approach, which is what I talked about, when I said the industry combined ratios in motor is at 124%, that is a lot more money to lose even relative to, let's say, the aggregate. What I said, industry is losing about 12 to 13 rupees for every 100 rupees of premium that they collect. So in motor, you're actually ending up losing almost 25 cents to $1. So that's a lot of money to lose. And therefore, in these times, it is far more important for us to make sure that we continue to stay invested in our service/distribution expansion initiatives. But at least insofar as growth is concerned, at an aggregate level, you will possibly see us underperforming the market. But this is how the nature of the business works. And hence, to that extent, I think we will obviously be able to kind of position ourselves far better. Whenever the cycle reverses, we'll be able to capture the opportunity of growth.
Are you comfortable losing more market share? I mean, what if the cycle doesn't reverse? You've already lost 60 basis points in motor, for instance. I mean, what is your plan B or the thinking behind it?
Absolutely. I think this is again, I think I would again kind of put this in the context of, because the informations are all in the public domain. I think companies which have tried to be very aggressive, again, if you would have seen over the last 2-3 years in specific, clearly you have seen them significantly getting impacted in terms of their combined ratio/profitability outcomes. And today, if you were to see the growth numbers of some of those players, they have significantly calibrated growth. And in some of the instances, they've actually kind of degrowing their book. So that's exactly what happens, particularly when you start to see your combined getting impacted, profitability is getting impacted, solvency getting impacted. So that's exactly the nature of the business that we are in. And over a period of time, and just to kind of refresh quickly, in motor, while I said currently we're at a market share of 10.5%, post-COVID, actually our market share came down to 9.5%. But since then, when we saw an improvement in pricing, we were able to improve the market share from 9.5% to 11%. And today, I think again, when the competitive intensity is far more elevated than what we would have expected, happy to stay guarded and cautious and wait for the cycles to reverse.
Very quickly, sir, you said you're going to be shifting more towards private in the motor segment. What is it at? What is the mix currently? Very quickly.
The mix for private is about 55%, two-wheelers is about 27%, and the rest is commercial vehicles.
Okay, all right. So you're saying greater focus on private, right? So the number goes to what?
So Nigel, again, let me just put this in context. This number is for the current quarter. Okay. If the market environment change, this mix can completely undergo a change.
All right. Not out of questions, but out of time. Thanks a lot for joining in. We look forward to having a chat with you, maybe in the middle before the next quarterly numbers.
Thank you, sir.
But it's time for our special segment, Quarter Se Quarter Tak. We bring expectations from each sector. Today, Upasana is going to tell us how the expectations are in the consumer durable space. Upasana, over to you.
Consumer durable companies are expected to post mixed growth trends in Q1 FY26. During the quarter, cable and wire segment witnessed a robust growth led by strong volume growth and price hikes. Now coming to EMS companies, this pack continues to outshine as demand tailwinds continue to drive growth. On the flip side, AC players are expected to witness a weak Q1 owing to delayed summer and early monsoon disrupting their overall sales. Now coming to cable and wire players, strong growth momentum is likely to continue and exports are expected to pick up. Cable and wire volume growth is expected in mid-teens, indicating a solid start to FY26. Strong execution of government-led projects, steady demand from real estate projects, and a pickup in exports should drive robust growth during the quarter. Now, Motilal Oswal estimates aggregate revenue growth of 17% in Q1 FY26 versus 11% seen last year amongst these players. Given the volatility in the commodity prices during the quarter, it estimates cable and wire margins likely to be flat on a year-on-year basis around 11.3%. Now, amongst the players, Polycab is expected to report highest growth of 17% on a YoY basis, followed by KEI Industries at 18%, while Havells and RR Kabil is expected around 15% of a revenue growth on a YoY basis. Now, Motilal expects margin expansion for Polycab and RR Kabil, while margins are likely to contract for KEI Industries and Havells. Now, coming to RAC and other appliances segment, weak summer affected the demand for RAC and other summer products. Industry demand for RAC is estimated to decline by 20 to 30% in Q1 due to high base, disrupted summer, and even aggressive channel stocking seen in Q4 FY25. Industry leaders such as Blue Star and Voltas full-year growth guidance remains intact as they are hopeful of making up for the lost demand. Also, Motilal estimates UCP segment revenue to decline by 16% for Voltas due to decline in their RAC and air cooler category, and 14% decline is what they estimate for Lloyds. In ECD segment, Kotak estimates 5% growth for Havells, while Crompton expects a decline to be offsetted by double-digit growth in pumps and appliances. Now, coming to the main EMS companies, they are likely to outshine with their strong revenue growth trajectory and aggregate revenue growth of nearly about 51% on a YoY basis in Q1 FY26. This is mainly aided by healthy demand across end-user industries and even strong order book execution. All EMS players are likely to report revenue growth, barring Syrma SGS. Dixon continues to lead the pack with strong and anticipated revenue growth of 82% on a YoY basis, followed by Keynes at 50% and Sign DLM at 7%, and lastly, Amber is estimated around 6% on a year-on-year basis. Overall, EBITDA margin is likely to contract for this pack by 10 basis points on a YoY basis, led by margin contraction in Cyan DLM and Amber. So let's see what holds for consumer durable as a category, but overall we are expecting a mixed growth trend.
Okay, all right. Thanks a lot for that, Upasna. Well, we have Praveen Sahai, the research analyst at PL Capital, who joins us on the show. Hi, Praveen. Good morning. Thanks a lot for joining in. Well, first up, we have some news flow on Dixon overnight with regard to their JV that they've done and that small acquisition as well. How does it change things for them? If you could put a number to the EPS upgrade you could see, say, in FY27?
Yeah, hi, Nigel. So one thing is Dixon is not under our coverage, but entering in the component that will first make them a backward integration, and definitely that will add to their profitability from here on. So yeah.
All right. Okay. All right. Let's focus then on the quarter numbers itself. If you had to pick an outlier in terms of a positive surprise, which would that stock be from the coverage universe?
Yes, so wire and cable companies are expected to deliver very strong numbers in terms of the volume as well as improvement in the margin. So Polycab is one of the company which expected a top line growth of around 18.5%, which is a mix of domestic wire expected around 20% growth in their revenue, led by the largely volume. And similarly, that the KEI also expected around 17% of a growth on the overall basis. Their wire and cable also expected around 20% of a growth. So these are the the wire companies, wire and cable companies are expected to outperform in the spike, whereas RR, which is more on the wire-based company, expectation for the growth is around 15% for their wire and cable. Overall, they are expecting around a 12% of a growth in their top line for this quarter. even there is an improvement in the margin profile because the copper prices, if I look at, has been a quite a firm for this quarter versus the last year first quarter. So that is the reason there is a good improvement in the margin, and we are expecting the probability for RR to improve by around 32-33%. And so as for the polycap, and KEI is on the little lower side because the margin expected to be maintained on the YY side or for 10.3, 10.4%.
But broadly, the wires and cables will have a good quarter. But they're also expensive. So between KEI, RR Cable and Polycab, which stock offers the best risk reward at this point?
Yeah, you are right. They are now run up quite significantly post correction due to a news of a new entrant. If I look at Polycab, it's trading at 36 times FY27 earning, 35 times for KEI, considering KEI 23% of earnings CAGR and 18% CAGR in the Polycab. My prefer here is a KEI because a KEI is a more on the HT or the LT cable based businesses, as well as extra high voltage segment to kicking from 27 for a KEI, and that will be a higher margin and also will drive the top line for them. So I think KEI is a better placed at this point, trading at a 35 times, and our target multiple is around 40. So there is some good upside in the KEI. Versus other two, whereas RR is trading at around 30 times, and I believe the maximum 32, 33 times is a peak for the RR, looking at the volatility in the business.
Voltas, which operates in the room air conditioning market. Now we know that Q1 was a tough quarter on the back of this unseasonal rains, but that's well documented. The stock, in fact, is down 22% from the start of the year. Is this a good buying opportunity? Do you see the cycle turning and things improving, from a demand point of view? Not backward looking in Q1, but just looking ahead for Voltas.
Yeah, sure. So for Voltas for the RAC segment, there is a one event lined up for the 1st Jan 2026. That's a BE norm change, and that will further increase the cost by 800 to 1,000 rupees. Now the summer has been very bad. Now there is a pressure on the the brands to liquidate their old inventories as well. Usually Q3 is a quarter where the most of the inventory filling is started for the summer, next summer. So I think Q3 definitely they will bring the volume, but the margin may be at the pressure because of a liquidation, because the offers and discounts they need to give. Because in the past quarters we had not seen even a tough quarter. There is no much discounts or scheme were there. So I think the margin is under pressure, will be pressure the way forward. And further, if all things is eyeing on the next summer, if that will be not so great in terms of the prediction, then there would be a pressure on the margin further of increased cost, how they are passed on. So I think we need to wait for a Voltas for the next 2 quarters at least, especially looking at the scenario in the industry. Also, I can highlight over Voltas that's their project business to somewhere is quite volatile because of international projects. There are some hiccups they are facing in. So I believe I think we need to wait for 2 quarters, and then after we'll look at the Voltas.
Thank you very much for joining in. Get into a break. On the other side, Manisha will join in to talk about commodities. Stay tuned. Welcome back. Things are quiet, at least on the index front. The Nifty and the Sensex down just a bit, 0.2% lower. Mid-caps flat in the green for now. Manisha is now joining in, and she's got her eye on copper. Manisha.
Well, thank you for that. Yes, that is because most of the metals are not trading in the positive, but copper is, and LME markets really have seen some support come back as well. That is because you're looking at better than expected Chinese data. The GDP numbers, the services numbers were on the stronger side, and various economic data reports show that the improvement in demand is sustaining, whether it's about US or China or Asia for that matter. The market's also clearly reacting to the US levying 50% of tariffs on copper from 1st of August, and the inventories ahead of this tariff has striped up to nearly 7-month highs. A lot of metal from various parts of the world has been flown into US ahead of this deadline of 1st of August. The lack of official details on whether it's going to be about just copper or copper products or copper cathodes, that clarity is something that the markets are still awaiting. So ahead of that, you've seen copper in all forms being imported into US. Well, apart from that, the premium between the US and LME, well, that continues to hold at a record 25%. And the markets do believe that this will only start to ease after 1st of August, once you have more clarity on the products and, of course, the kind of inventories that US seems to be holding. And that is the reason you're looking at such a huge price disparity that we have seen on LME and in US. When you look at the last 1 month, well, LME has seen a 2.5% decline in case of copper because there are no more takers. Whatever copper had to be sent to US already has been done. So now the copper just continues to lie around. And we've also seen the LME inventories gain up. The COMEX copper prices in the meanwhile in the last 1 month have gained up by 15%. And that exactly mirrors or calculates onto the YTD so far. While the LME copper is just about gained 10%, the US copper prices are up by 38% at this point in time. Well, US does import nearly 50% of its refined copper requirement. Much of that comes in from Chile, Canada, and even as China exported copper worth $866 million to US in 2024, the markets do believe that a lot of other trading partners with US are not in a very beneficiary state, and China perhaps could be sending more copper to US. Canada, Chile, copper just about has turned expensive, and this could really change on how copper is going to be traded globally after 1st of August. If you look at supply disruptions, that's yet another thing that the markets are really taking in support from. Remember, copper is essential to modern industry like EVs, infra, and defense as a sector. There is supply disruption that has been reported from Congo, Peru, Chile. Chile is looking at drought concerns, by the way. So supply disruptions, strong demand, and of course, the tariff concerns, all of those factors are keeping the copper prices on the higher side. What is going to be even more important is the whole host of data that is coming in from US. You have jobless claims, retail sales coming in, also the home sales, builders' confidence data, all of that comes in today. And then apart from that, there are 4 Fed officials also slated to give out speeches. Markets will be taking further cues from all of these.
Okay, all right. Manisha, thank you very much for that. State Bank of India is in focus. Sources tell CNBC-TV18 that SBI is likely to launch its 25,000 crore QIP as early as today. Vivek is here with details. Vivek, morning.
Well, that's right. In line with the story, our colleague Ritu had put out, towards the end of last month, what we understand from our sources that SBI is all set to launch its mega QIP. Remember, the company is looking to raise close to 25,000 crore via the QIP route. And we understand that this QIP may be launched as early as later today. Remember, we've reached out to both SBI, and we also reached out to LIC. We understand that LIC is going to be one of the primary participants, one of the anchor participants in this large QIP. We understand that there has been a soft commitment from LIC to put in bids for as high as a little over 5,000 crore rupees for this particular QIP. We also understand that demand from both the mutual fund industry, especially domestic mutual funds, has been very, very strong. SBI is likely to offer a very minor discount to this particular QIP. We understand there's probably going to be a discount of just 2 to 3% to the current market price for this particular QIP, keeping in mind that the demand has been quite strong. We reached out to both SBI, we reached out to LIC as well. Once we get a response from both the bank as well as LIC, we will update our viewers on the same. Just to give a quick update as to what exactly our colleague Ritu had reported earlier. Remember, Ritu had told us that there were 5 bankers that were appointed for this particular QIP, and the main reason for the QIP is to go ahead and augment the capital base of the company. Remember, if SBI goes ahead and successfully completes the fundraise, it will be the first share sales of the bank since 2017.
Okay, all right. Thank you very much, Vivek, for that. Markets, of course, are down about, 60 points or so. So it's a little slightly muted kind of day, 24,140. Network 18, the stock is rallying 11% in trade post its first quarter numbers. The margins have improved for the company on a year-on-year basis, while its share in viewership has risen too in this particular quarter. Let's listen in to what the company's managing director, Rahul Joshi, had to say on the performance and, of course, the road ahead for the business going forward. Just a quick disclaimer, CNBC-TV18, the channel you're watching, is very much part of the Network 18 group. Listen in.
If you look at the last 2 quarters, they have been incredibly tough for the media industry. The operating business environment has been soft. Clients are not spending as they used to. That earnings have been under pressure. I don't need to tell you all of that. In this environment, we have managed to post a 5% dip in revenues. That has to be seen in the context that in the first quarter of last year, it was an exceptional quarter because of election results. It was a bumper quarter for us. So if you were to compare it from the quarter before that, we have grown a healthy 9%. But from last year, it is a dip of 5%. But at the same time, we have kept a tight, very sharp eye on costs. We've been able to control costs considerably. So that is what has reflected in this somewhat improved margins. So I'm very happy with the operating team's performance this quarter. I think it was a tough quarter in which they really came out tops. I think that, in this first quarter, we are EBITDA positive. If you look at the next 3 quarters, I'm hoping that, the overall outlook will improve as we head towards the festive season. I am hopeful that since our channels and our digital properties are all in commanding leadership positions, we will be able to not only drive revenue, but we will keep costs under control in our existing businesses. Costs are mildly likely to go up only in our new investments, maybe in areas like First Post or in money control. So overall, I am hopeful that the next 3 quarters would be better. We are seeing some green shoots, but early days, I would say. July is looking slightly better. I wouldn't be very excited yet. But I think as we hit the festive season, I think we will see some impact on higher revenues. And you have to see it in the perspective that we are the #1 media company, broadcaster, news broadcaster and digital media company. We have a commanding position in the market. All our channels are #1 by a wide margin. We've only increased the gap with our #2 player, whether it is our news channels or it is our digital property. So much so that News 18, for instance, has beaten the Times of India, in the recent ComScore numbers. So that gives us a lot of reason to cheer, and that gives us also a lot of hope for the future.
That's good. Almost doing the same. Can I start?
Bank of Maharashtra has once again posted a pleasing set of numbers with a 23% growth in profits. Advances have grown 17%, deposits by 14%. Both are above industry levels. NIM's net interest margins are down, of course, with all the rate cuts, but they're down only by 6 basis points. The point I'm trying to make is this is one of those rare public sector banks with a 1.8% return on assets, ROA. And a 23% ROE, I think 23% would be the highest among all banks, and 1.8 ROA is definitely the highest among public sector banks. On that note, let me welcome Nidhu Saxena, the Managing Director and CEO of Bank of Maharashtra, to our studio. Thank you very much, Mr. Saxena, for coming over to our studio itself. This conversation is always better.
Thank you for having me, ma'am.
Okay, let me start with the profits. The 23%. Now, one small advantage you had was the tax write-back. This year, you told me last time the tax write-back will be over. So, will you still be able to post, another 25%? You've done almost 1,600 crore. So, can you give us a profit of 6,000 crore this year?
Right. So, you're right. We have accumulated losses which are remaining to be adjusted, which are available for this FY 25-26 of around 1,200 crores. So, we were aware of this, mindful of this. So, 1,200 crores I will be apportioning in 4 quarters mathematically equally. But what is not going to change, I don't see much headwinds here. I should be able to achieve my guidance and achieve the profit numbers that we are looking for. Basis which I am telling this, we have been doing extra provisioning. So we are mindful what RBI for some time, regulator tells that these are the best times, good times. Keep yourself extra cushioned, keep making extra provisionings and make yourself better for that if the cycle tomorrow has to reverse. So if you ask me, every quarter more than what IRAC norms are there, we are doing some extra provisioning, quarter on quarter basis. That provisioning will be now shifted to making extra provisions for my taxes. So by and large, that is, so this is one. Secondly, we are also growing fast. And when my growth is happening top line, mantra is very clear, growth with profitability. Yes. So we are very, very conscious about bottom line's growth. And I think put together these two things, we should be able to manage, and what we plan, we should be able to do also.
Okay. Now let me come to the more crucial question of margins, which we will ask all the bankers. You have lost only 6 basis points. What is the see, at that time only one rate cut had come. Now with the June rate cuts, you have got another double dose. So what can be the impact on margins?
So we have done our calculations with 100 bips of rate cut in stages that have come. It impacts my NIM to around 19 to 20 bips.
Okay.
If you see my cost of funds and cost of deposits in this period has come down by 15 bips. And very, very consciously, we are trying to see NIM contraction is bound to be there. And to what extent we can arrest that NIM contraction. Okay. So 15 bips versus 20 bips, there's a 5 bips. And if you see my Q4 NIM was 4.01.
Yes.
I have done 3.95. So it manages.
Okay.
And how we have done the cost of deposits is that we have focused more on the low cost component of the liability side. And very strategically, we have shunned the high cost bulk deposits and replaced them with alternate sources of refinance and raising infra bonds. Trying to see, and that is actually helping me protect my NIM.
So what may you end the year with in terms of NIMs? So there will be a cut in the coming quarter as well. I mean, that is in the current second quarter. But then in the third and fourth quarter, you're getting a little bit of CRR advantage.
Right.
So you may end the year with what kind of margins, exit margins?
Right. So, yes, you rightly said the retail inflation number has come.
Yeah.
Even we have looked at the governor's statement, and there is a scope for a rate cut. And we are okay with the more rate cuts as they are coming. I have a 40% portfolio which is linked to the repo. So it has to be mandatorily passed to that. We will do that. CRR, my around 12,000 crores of funds are blocked for meeting the CRR of at 4%.
Yeah.
Now, with 3, I'm going to get 3,000 crores freed. I will earn something on that 3,000 crore. That is one thing which will some way offset the part of it. Then in the last 10 to 12 months, we had also done some MCLR review. And 35 bips of MCLR was actually raised. There is some portfolio which is yet to be repriced. I have 55% portfolio linked to MCLR.
Okay.
And we will see another 1 or 2 more quarters where repricing will be happening. So put all together, I am keeping a guidance of 3.75, which is a conservative guidance. This number also I had kept for last year. Despite doing 3.97, 3.98, 3.98 and closing the year with 4 NIM, my guidance last year was 3.75. I'm maintaining that conservative guidance.
But you're likely to overshoot.
So that's what we always want to wish to give the comfort to the investors that MD says and we are able to deliver, bank delivers what guidance number is there. So we want to be conservative. 3.75 is the...
What about advances? Will you be able to, this 14%, 17% growth in advances is, very good compared to the system, almost double. System was running at 9% last quarter. Now it has risen to 10. Where will be the growth triggers? Will it be retail? You have not done much on MSME. Will that be, what will be your growth horse?
Right. So we are looking at all the verticals. And I am trying to look at wherever the profitable growth opportunities are there for us, we will definitely participate, whether it be corporate, MSME, agriculture. So RAM plus corporate, I have kept a guidance of doing 60-40, but that number is not something sacrosanct as we see more opportunities. So in the corporate book, we are bullish in sectors where there is a lot of emphasis coming from government. So in the infra, and we are also examining what the risks are there. We are comfortable with road projects under HAM model which are coming from NHI. We are bullish on LRDs. In my last 12 months, we have done a lot of green finance. So renewable energy is one area where we are very bullish on. Data centers we are doing. So all these kind in the corporate sectors, corporate side we are doing. RAM is also doing fantastic. Agriculture and MSME, these two verticals, I have created 2 verticals this year to have a complete focus. And we have done, then the third element is some co-lending interesting partnerships. I have ramped up the co-lending partnerships from 2 when we began the year to 9 now. And it is becoming a substantial book. We are using some in-house technology that is there to take care of the transactions.
Fair points. Actually, I'm out of time, and I wanted to ask you about the way in which you have been able to get the Supreme Court of India account and other accounts, but that longer discussion for another day. Thank you very much indeed for joining us with your thoughts.
Thank you so much for having me.
Okay, so that's the word coming in from Bank of Maharashtra. Excellent set of numbers. And I think an OFS will also